I think stocks are in this sort of zigzag pattern. We think the S&P can get to at least 7,000. These pullbacks get bought. So we could be weak today, and I think we could rally tomorrow. And it actually seems like the payback for AI, whether it's applications or services, actually has improved in the last quarter or so. I think we may be underestimating the sort of profit creation coming from AI. When I hear people say, oh, well, this reminds me of 1999, or, they're ringing the bell on the top of AI stocks, I just think a lot of good news has been accepted by markets, but I don't think it's necessarily priced into markets. Retail is really the cohort that saved the market in April because they were buying that dip. I think institutions have been reluctant and now are allocating in the fourth quarter because, there's beta and this has not been a great year for many stock pickers. So this fourth quarter is their chance to catch up. I think tech has been the leader. I do think market will broaden. So, as people stay reluctant, I think there's still a lot of upside into year end.
In today's video, Tom Lee shares why he believes we're still in the most hated bull market and why both stocks and Bitcoin could surge into year end. He breaks down how AI-driven profits and liquidity flows are fueling risk assets, why institutions are rotating back into equities and crypto, and why he sees the S&P hitting 7,000 as Bitcoin regains momentum toward new highs. Tom also highlights how market skepticism is setting up the perfect backdrop for another major crypto rally. Don't forget to subscribe and join our Telegram for exclusive Bitcoin and market updates, links in the description below. Let's hear Tom's outlook.
Well, I think markets are trying to balance a few things because we are navigating a little blind because of the government shutdown. But we also know that the real powerful driver of the equity market and the economy has been AI, which is not affected by this slowdown. So I think stocks are in this sort of zigzag pattern, but given we're in that seasonal period from October to year end, and we think the S&P can get to at least 7,000, it has been, and we've seen it this week, these pullbacks get bought. So we could be weak today, and I think we could rally tomorrow. And in general, I'd still be bullish into year end.
Are we whistling past the graveyard, Tom, on anything that could be concerning to you? I see a story right in front of me from Axios mentioning a Moody's analysis. 22 states are in recession or close to it. There was that Carlisle independent survey the other day showing the labor market is much worse than expected. Gold's been going up. Some suggest that's de-risking from the U.S. AI bubble. You mentioned the shutdown. Are we complacent towards any significant risks that we might be missing?
Well, I do think markets are less skeptical than they were in April and even in August and September, and we can see this in both positioning and AAII. So I think it is fair to say that the markets have priced in more good news. So like the things you flagged can be worrisome. But what I'd point out is that I think the AI story is actually strengthening, Scott. From our conversations with both companies and investors, it actually seems like the payback for AI, whether it's applications or services or companies' actual ROI, actually has improved in the last quarter or so. So I think that's what's helping actually create demand for spending. So I think we may be underestimating the sort of profit creation coming from AI, and I think that's why there's still legs to that story. But you're right. On balance, the data is mixed, and we don't really know because we don't have government data.
Yeah. You gave our producers this line that you still think it's the, quote, most hated rally. And I've asked you about this every time you've been on with me. I feel like now that's a little bit far-fetched to suggest that this is still the most hated rally. I don't find anybody who comes on, certainly not on the programs that I do, that is overly negative about anything. The prevailing view, even from those who were cautious before, are like the stock market's going higher. Now, it may end poorly way down the road, but it's going higher. So how can you suggest that it's still so hated?
Well, there's this thing where people can make like a backhanded compliment, like they might say something positive about the market, but they're really bearish. Because when I hear people say, Oh, well, this reminds me of 1999, or they're ringing the bell on the top of AI stocks. They are maybe acknowledging that the market is strong, but then they're trying to mark the end of that rally. And I think, for me, who was an analyst in the 90s, people forget that Cisco in September 98 was almost a 60 PE when the Fed made its first cut in 9 months, and then its PE went to 200. NVIDIA is that stock today, and it's trading at around 27 times forward earnings. I mean, it's got a lower PE than Walmart and Costco, which are like 35 to almost 50 times. So I just think a lot of good news has been accepted by markets, but I don't think it's necessarily priced into markets.
Tom Lee about what sentiment is this market. I mean, that is another thing, Tom, that investors are watching, just this interaction between the United States and Argentina. It just brings up geopolitical issues, the fragility of some other nations, and certainly their maybe financial stability, which we are keeping a close eye on. The market doesn't seem to be too overly concerned about that. In terms of how investors really feel about what's happening here, I thought it was notable that JP Morgan's Retail Radar paper today said that investors were accelerating their purchases in stocks. This goes back to what I was asking you about. Is it really such a hated rally if retail is leaning in even more? $7 billion this week in purchases. That's well above the 2-month average of 5.3. Do you want to address that?
Well, as you know, retail is really the cohort that saved the market in April because they were buying that dip. The other three cohorts in the market are, of course, institutional, and then there's international, and then what I'd call family office and super high net worth. Of those three, I think institutions have been reluctant and now are allocating in the fourth quarter because there's beta and this has not been a great year for many stock pickers. So this fourth quarter is their chance to catch up. On the international, as you know, much of the flows were out of the U.S. and into non-U.S. stocks, and that's beginning to reverse. And then on the high net worth, I think there is still a stubbornness about being skeptical of stocks, and that's why I think there's still what we call the most hated V-shaped rally. The retail has not hated this rally. They have been buying since April.
You just said that you think flows into international markets is starting to cease or at least slow down because the calls on the street that we've gone over the last few days have been anything but suggesting that that's going to take place. I mean, there's been a number of upgrades of not only emerging markets, so we just showed the EEM, the ETF that tracks it, and it's straight up to the right. And other developed markets like Europe as well. I think there's still a fair amount of optimism as the U.S. performance trails that of those areas.
Yeah, Scott, I mean, it's I think that when we look at the balance of flows, as you know, the U.S. has outperformed non-U.S. for more than a decade. And we are seeing a little bit of catch up here. But one of the things that I've been finding as I've been visiting with international investors, and next week I'm actually in Latin America visiting clients, is that investors are buying non-US because of valuation, but the E part of the non-US isn't really as attractive because the US earnings growth is getting a big tailwind from AI and the leadership from not only just AI stocks, but also US financials. And so I think the earnings story is what's causing some of these who've made non-US as a factor bet, realizing that you got to still have a lot of E to support this move. And so I think that that's why you're going to see that as a tailwind into 2026.
Tom, wrap it up on this note. The tech sector's forward PE today is 31 times as people talk about valuation and how much tech and AI has meant to where we are. The 20-year average is 17.9, so 31 versus 18. Is that okay?
Yeah, I'm okay with that because I think visibility is much better. Tech is not the pure cyclical group where you actually sell it at low PE and buy at high PE. This is a group that you buy because there is visibility. And I do think that the PE expansion isn't going to just be tech going forward, Scott, because the ISM, and you guys had this conversation just now, has been below 50 for 31 months. That is a big percentage of S&P earnings that can accelerate when confidence recovers, and that is actually likely going to pivot as the Fed embarks on a cutting cycle. So I think tech has been the leader. I do think market will broaden. So, as people stay reluctant, I think there's still a lot of upside into year end.
Tom Lee's message is clear: we're still early in this cycle. As AI strengthens earnings and Bitcoin regains global momentum, the wall of worry might just be the fuel for the next big rally. If you found this breakdown insightful, make sure to subscribe, like the video, and join our Telegram for exclusive crypto and market insights. The next wave of capital rotation is already starting. Don't get left behind.